Good evening and welcome to our Summer Term Money webinar series by the Institute of International Monetary Research in collaboration with the Vinson Center for the Public Understanding of Economics and Entrepreneurship at the University of Buckingham. I am Damian Pudner, Director of the IIMR, and today we are very fortunate to be hosting Daniel Lacalle. Daniel, a PhD, economist and fund manager, as well as author of several best-selling books on economics and energy, including Life in the Financial Markets, Escape from the Central Bank Trap, The Energy World is Flat, and Freedom or Equality. Daniel is a regular contributor to the likes of CNBC, Bloomberg TV, The Wall Street Journal, and many other leading financial outlets. Daniel has been a board member and strategy advisor of various global companies, including Lone Star Resources and Orga Negro. For 5 consecutive years, he was voted top buy-side professional at the Thomson Reuters Extel survey, and in general strategy and in oil and gas. Today, we will discuss the importance of sound money for economic progress, after which we will allow time for a Q&A with viewers online. As always, today's presentation will be recorded and made available on our YouTube channel. Please see our website at www.mv-pt.org to access this and other webinars in the series. A reminder that questions must be submitted via the Q&A option, which I will moderate and address to Daniel. We may not have time to get through all your questions submitted, so if that happens to you, please do email us on inquiries@mv-pt.org, and we will pass on your questions to Daniel, who will then endeavor to respond. And with that, I'll happily hand over to you, Daniel.
Thank you very much. Thank you very much to the Institute of International Monetary Research and the University of Buckingham for this opportunity to talk a little bit about the importance of sound money. And I think that the best way to start our conversation is to define what sound money is. Ultimately, sound money is the policy that makes an issuer, be it a government or a central bank, maintain the reserve of value status of a currency and guarantee that it continues to be money, i.e., a reserve of value, a unit of measure, and a generalized mean of payment. Unsound money, on the opposite side, is what we could describe as the political use of currency. The political use of currency is basically trying to disguise the imbalances created by the public sector by issuing more currency than is demanded and abandoning the principles that I mentioned before, maintaining reserve of value, unit of measure, and generalized mean of payment items. Unsound money is what we have been accustomed to hear from some so-called neo-Keynesians, the social use of money. But I think it's much better to call it the political use of money. And it's basically when governments incur into massive deficits, they increase the size of government in the economy, they obviously transfer those imbalances to citizens via the monetization of that deficit, and that ultimately means higher inflation, higher level of taxation in the future, and certainly, as we have seen so many times in the past decade, a higher level of debt. Ultimately, the so-called social use of money is a mistake because in many ways, the alleged benefits that it's supposed to create are far outweighed by the negatives that are created. The negatives are a few. By introducing interest rates that have nothing to do with what the market would dictate, what the central bank ultimately is doing is disguising the price of risk. And disguising the price of risk has one motive: to allow governments to gain more time in order to reduce their imbalances, to conduct the structural reforms that will allow them to come back to a level of debt and a level of deficit that is more sustainable. However, as all perverse incentives, low rates and rates well below inflation, i.e. negative real rates, or even negative nominal rates, as we have seen in the Eurozone, are not a tool that allows governments to reduce their imbalances and to conduct structural reforms. But they become a tool to ignore them, to ignore the need to make structural reforms, to ignore fiscal prudency, and to believe that there's always going to be somebody that is going to monetize or disguise that huge difference created between the revenues and the expenses of the government. To the extent that what we have seen in the last years is that governments have grown accustomed to enter into huge deficits in periods of growth, but also in periods of crisis. In periods of crisis, they say, hey, the government has to step in and needs to implement social measures that are going to offset the negative impact, mitigate the impact of the crisis. However, in periods of growth, they also undertake very significant deficits because they have to grow. Ultimately, so what happens with very low interest rates is that it's providing a false sense of security and a false sense of low risk, to the point that we have seen some issuers that have increased their debt to GDP from below 90% to above 110% of GDP in less than a decade, see their cost of borrowing come down. One could imagine, well, that is a good thing. If the government pays less for its debt, that means that it can undertake social programs and that it can pay for more entitlement programs with less of a burden on the budget. However, there's always another side to the coin. The negative interest rate scenario creates very significant and dangerous side effects. To start with, malinvestment. A lot of the decisions of spending and investing in the public, but also in the private sector, are conducted with a lot less rigor than they would have been conducted in an environment in which the cost of risk would be realistic. Ultimately, implementing negative real or nominal rates is a way of subsidizing taking risk. And absolutely every aspect of this policy decision generates a negative side effect that outweighs all the positives. The negative side effects are obviously, first, that governments decide to forget about fiscal prudency, forget about cutting the deficit, and forget about having a balanced budget. We have grown accustomed to reading of countries that have not had a balanced budget since 1973, 1975, no? And there's another problem, multiple problems. Malinvestment, because companies, businesses see that the cost of borrowing is relatively cheap, therefore they take more risk than that they would take in normal times, believing that the risk is lower when it's simply subsidized by implementing negative nominal and or real rates. Malinvestment is a problem, but there's also a much larger problem that is created, particularly in economies in which the access to credit is more driven toward the larger corporations. It's called zombification. The Bank of International Settlements shows that the percentage of zombie companies in the economy has multiplied in the period of negative rates. And it's logical. Those companies that are unable to pay their cost of debt, their interest expenses with operating expenses, can continue to exist, and therefore an important part of progress, that is creative destruction, ends up being obliterated in the economy. What ends up happening with negative rates is that those that have access to credit, even if they are not having a prudent policy, even if they are not generating good returns, even if they're loss making, those will survive at the expense of all of those that could have led the way to a more productive and more innovative economy. And zombification is extremely negative for innovation, because innovation comes mostly from creative destruction. Somebody has a new idea, that new idea, technology, whatever, displaces the incumbent. The incumbent, therefore, either has to adapt or disappear, and productivity growth increases, salaries go up, the economy is stronger, etc. All those things are positives. However, zombification does the opposite. Zombification makes the transition generated by innovation much slower. Clearest example is that we have seen virtually no innovation in solar panels or wind turbines in their engineering because of the enormous amounts of subsidies, etc. So, malinvestment and zombification, important factors. Third, very important negative factor for families. When families go to their bank and see that they're getting a mortgage at 1.5%, 2% at 40 years, they think, obviously, that risk is very low and that their credit viability is very strong. However, what they don't see is that the price of that mortgage is extremely artificially manipulated. Furthermore, what happens is that those families look at how much they're going to spend every month to pay for the mortgage. They find it acceptable at very low rates. And then when inflation creeps in and rates go up, they suddenly find that even a modest 20, 30% increase in the cost of borrowing makes them go enter into very significant financial difficulties. So the idea that negative rates are going to help the economy improve is debunked by reality. We have seen that with negative rates, the Eurozone has not only not delivered the kind of growth that it was supposed to, but it has fallen behind the United States and other developed economies. That with negative rates, the fiscal imbalances of governments have not been reduced, but actually increased in most cases, particularly in the cases of countries with the largest imbalances. And at the same time, that those negative rates have created very substantial risks of zombification, malinvestment, and excess risk taking, both from families and the private sector. But that is on the cost of money, okay? And that is obviously a negative. We must remember that artificial money creation is never neutral. It always disproportionately benefits those that are the first recipients of money, i.e., indebted governments and the most indebted corporations, and disproportionately negatively affect those that are the last recipients of money, i.e., real wages and deposit savings. So there is no fiscal policy that can change that. No fiscal policy can mitigate or offset the negative impact of artificial money creation that in itself is a guarantee of increased inequality. If I have access to debt and if I have access to capital, I am going to benefit regardless of my strength as an issuer or my strength as a company or as a government. This is very important because credit is not going to the most productive part of the economy, but to the least productive part of the economy, starting with the crowding out that governments implement in the economy. Obviously, deficits are always financed in most developed economies, always financed at lower costs than what small and medium enterprises or families borrow. All of those problems mean that more credit goes to the least effective issuer and less credit goes to families and businesses. It becomes more difficult to raise cash or capital for small and medium enterprises, yet it becomes very easy for multi-billion-dollar corporations that are on their sort of maturity to obsolescence phase to access plenty of capital, even issue bonds at negative rates. Why does this happen? For investors, a situation of negative rates and a situation of artificial money creation becomes an environment in which most bondholders will think more about the return of their money than the return on their money, i.e., they prefer to buy bonds with negative yields and receive 99 cents from a dollar than to invest in a risky business that may generate a 20-30% return. The other problem is the quantity of money. Many of you may have heard that the central bank does not increase the quantity of money or set the rates in the economy. It simply follows the demand of the private sector. Well, if that were the case, the only thing that the central bank would need to do would be to let rates float freely. However, they don't do it. If it's true that they only follow the demand of the market and what the market is requiring, then rates should be freely moving, and they're not. But the quantity of money is even more dangerous. What the central bank does in what we call quantitative easing is literally creating an enormous imbalance in the credit supply of an economy in favor of the least productive, or at least the least efficient part of the economy, which is the government. It makes extremely expensive the sovereign bond. By making extremely expensive the sovereign bond, it makes very cheap every other asset in the economy, and therefore disguises the risk that we are taking when we invest in equities, in bonds, etc. And you see, for example, how as the yield that governments pay for their debt is lower because quantitative easing is making those bonds much more expensive. The central bank basically is becoming the demand for those bonds, to the extent that in the Eurozone, at some point in the last, actually a few years, in the last 5 years, the European Central Bank was more than 100% of the issuance of each of the member states, i.e., it was willing to buy more than 100% of what they were going to issue. That creates an enormous imbalance. To start with, obviously, the weighted average cost of capital of companies is distorted. And then we perceive that very risky sectors are actually very cheap. So we take more risk for a lower return. High yield, instead of trading at 300, 400 basis points above mid swaps, trades at 100, 150. So it creates the bubble of everything. And quantitative easing and unsound money generate this imbalance with an idea that by lowering the cost of borrowing and increasing the quantity of money in the system, ultimately, if you withdraw from the market all of those issued bonds from sovereigns, you are increasing the amount of money in the system immediately, and actually the monetary policy transmission mechanism explodes, because what those bonds used to be in the balance sheet of banks, it goes to the balance sheet of the central bank. Then the bank has to find other ways to generate a return on its investments with other reserves, and the newly acquired reserves are much more expensive. So it explodes the amount of risk that is taken by via that monetary policy transmission mechanism. It's not just that the balance sheet of the European Central Bank and the Federal Reserve go through the roof, is that the quantity of money in the system goes through the roof, to the point that first, it generates an enormous level of asset price inflation in the years in which we all heard, what are you talking about? Money supply growth does not create inflation. There's no inflation and everything is great and quantitative easing continues. Well, there was massive inflation. Obviously, we saw the house price index go hugely above the levels at which it went in prior years relative to disposable income and relative to savings. We saw multiple expansion in equities, massive level of risk taking in bonds, high yield bonds, etc. And all of that, multiple expansion is inflation. House price inflation is also inflation, obviously, and all of those factors are monetary. So when did this transfer to consumer prices? When the massive injections of liquidity from central banks went, that monetary policy transmission mechanism went directly to government spending. In the traditional quantitative easing process, the transmission mechanism is quite slow. The central bank purchases bonds, then the balance sheet of banks improves, and therefore they have more access to provide credit to families and businesses, and obviously to public entities, etc. But the interesting thing about quantitative easing is that it stops the CPI, the inflationary process in consumer prices, because it is always subject to demand from the private sector. You may increase massively the ability to lend from the banking sector, but if the companies and families do not decide to take more credit, then the inflationary process stays within the financial market. Multiple expansion, higher prices of houses, higher prices of commodities, higher prices of different financial instruments, higher valuations. Sorry, not prices, and most importantly, valuations. The problem is when that transmission mechanism is broken, and not only the central banks increased their balance sheet by 5 times higher than what they did in what we called the quantitative easing years, but all of that increase went directly to government spending, to entitlement programs. That is what creates huge inflation. And obviously, inflation is an impact on aggregate prices. The idea that inflation came from commodities makes no sense. You have all seen commodities have been falling all the time since the Federal Reserve and the ECB started to hike rates. That means that commodities had an abrupt increase due to extremely loose monetary policy, more units of currency going to relatively scarce assets, and came down with the reduction in the quantity of money and the higher cost of borrowing. It's more expensive to take long a position, finance margin calls, finance transport, finance freights. The moment that the Federal Reserve and the ECB started to hike rates back, commodities fell. But when they started to talk about the end of hike rates and the end of normalization, commodities since May have started to creep back up. So entirely a monetary effect. If we think about it, all these distortions that are created in the system by having unsound monetary policy, on the one hand, they generate diminishing returns on the positives that they're supposed to generate. What are the positives? Higher access to credit, higher level of growth, and higher level of employment. We see employment going up, yet we see real wages going down. It's logical. Productivity growth is negative or zero. Productivity growth is negative. Real wages are actually falling, not rising. The negative on growth is also evident. There is GDP growth, but as we saw recently in the United States, gross domestic income actually is not rising, is falling. But more importantly, even when there is real GDP growth, the debt to GDP of the public sector rises. So more debt means more taxes, more inflation, less growth, less employment, and certainly lower real wages in the future. There is a theory out there that says that deficit spending is a great thing and that governments should actually increase deficit spending because those deficits are reserves for the private sector. A deficit is only a reserve to the private sector if the viability of the issuer in terms of its financial viability and solvency and liquidity ratios remain. The idea that just because it is the state, any and every deficit is going to be absorbed by the private sector as savings makes no sense. It also makes no sense because the idea that governments don't repay their debt, they simply refinance it. Well, refinancing is repaying your debt and reissuing it at a higher cost. So ultimately, even in countries that try to control the yield curve and have enormous levels of debt like Japan, the government spends up to 22% of its budget in interest expenses. All of that means ultimately, as I said before, higher taxes, lower growth, higher inflation, or both, all of them at the same time. And the law of diminishing returns, these extraordinary measures, is very evident. If you all remember, the first quantitative easing program generated an enormous placebo effect in markets that sort of put the oil back into the financing economy. And it's fine for the central bank to be the provider of liquidity of last resort. The problem is when the central bank becomes the provider of liquidity of first resort, which is where we are now. When the central bank is the provider of liquidity of last resort, the challenges of solvency of issues, the challenges of the different aspects of malinvestment and excess risk taking appear and generate the level of creative destruction that we mentioned before. So it is actually still a relatively positive in the economy. When the central bank becomes the lender of first resort, the entire system of risk is completely obliterated. What we are seeing right now, for example, is that there is a perverse incentive in the banking system to increase the imbalances in the balance sheet, knowing that if there is a challenge in the bond portfolio, the Federal Reserve is going to come back and inject liquidity at very cheap rates, benefiting the ones that have done things badly and penalizing those that did not enter into enormous imbalances in their bond portfolio. It's amazing, no? So there is a narrative out there in the market that when I say these things, and many of us say these things, they say, so basically what you're saying is that the central bank should do nothing and that this should be the law of the jungle. Well, to start with, the law of the jungle does not provide credit to the least efficient part of the jungle. But no, it's not the law of the jungle. Central bank has a very specific role, which is to have a regulatory position in terms of the monetary system and the financial system, regulate, supervise, and certainly not disguise the challenges of the government or any of the issuers in the economy. It is not the objective of the central bank to bail out the government or anybody else. The objective of the central bank is to maintain the reserve of value status of the currency, and this is what's being under threat right now, because as the law of diminishing returns happens, and we see that with subsequent higher stimulus packages, the impact is lower, but the effect of higher debt, higher inflation, and worse economic growth happens, the confidence in the currency crumbles. We have the example in Japan. Everybody in the neo-Keynesian world said that Japan was a perfect example of how you could manage imbalances from the government side, and at the same time increase the size of government, increase the size of debt, and have very low risk. Well, the yen is at 14-year lows against the dollar. The minute that CPI inflation started to appear, the reality is that the entire mirage of the upside down view of economics that the Keynesians defend shows very abruptly. Now, what is dangerous is that every time that this happens, what we are going to read everywhere is that it's the markets to blame, when what we have in reality is a system in which the markets are not functioning properly. Markets are being led to take enormous levels of risk, yet they are not being rewarded when doing things properly and penalized when doing things negatively, to the extent that all of you may have seen how what we see, for example, in the numerous examples of announcements from the Federal Reserve on economic data, etc., is that you see that, for example, there is a bad piece of macroeconomic news, and oh, surprise, the market goes up. And why does the market go up on negative macro news? Because it expects massive monetary injections, huge liquidity injections. Therefore, it is extremely important to remember why sound money is better than unsound money. The idea that mitigating, offsetting, or disguising a bubble is a positive may look attractive at the beginning, but it's very expensive at the end. Cheap money is always very expensive in the long term. Cheap money always ends up affecting negatively those that receive a salary, those that have their savings in deposits. And what we have also is a situation in which those so-called negative side effects. Now, in many occasions, I remember reading a paper by Dr. Bernanke saying that there were a number of side effects that had to be dealt with afterwards, but they're not dealt with. That is the big problem. High level of debt to GDP, high level of malinvestment, huge increases in risk taking. All of those factors are extremely worrying in an environment in which the next phase is even more challenging, because right now we have inflation, not just transitory inflation. Remember that the central banks first said that inflation was just a blip, that it was transitory, that there was not going to be any challenge. Now we have persistent inflation, not just persistent inflation, but if you look at core and headline CPI, particularly core, relative to the reduction in monetary aggregates, it is even more concerning than one would imagine, because right now, considering the reduction in monetary aggregates, core CPI should be significantly lower than what we are seeing. In fact, almost half than what we are seeing in the US or in the euro area. I think that another very, very important factor is to remind that in this environment of persistent inflation, monetary aggregates are declining, but the biggest challenge is that the entire burden of the normalization of monetary policy is falling on the private sector. Governments are not suffering at all the monetary policy normalization. This is the first time in decades in which a monetary policy normalization aiming to combat inflation has no impact whatsoever on deficit spending and on government spending in the major economies. Actually, the opposite. While the central bank is increasing rates and reducing the balance sheet, the governments in the Eurozone are implementing a massive next generation EU fund, and the Federal Reserve is seeing how Bidenomics is increasing the deficit to levels that were not seen in a period of growth in the last 20 years. Therefore, how does this all end? Unfortunately, what we are seeing is that central banks, seeing the reaction of markets, have called the end of inflation way too early. And they have not implemented the measures to really reduce the balance sheet. Yes, they have reduced the balance sheet, but if you look at it, the majority of the reduction of the balance sheet of central banks comes from the reduction of the value of the currency in which those central banks have their balance sheet, i.e., in the euro area, the euro weakening, in Japan, the yen weakening against the dollar. It's been basically a dollar strengthening position, and simply taking out of the balance sheet those bonds that matured, but not doing anything else. And this is relevant. Why? I said that the entire normalization of monetary policy is falling on the private sector, which means that you can have, and we are actually seeing, a private sector recession with GDP expansion in official terms. The example I mentioned prior is very evident, where GDP in the United States says one thing and GDI, gross domestic income, says the other. But it's also important because the size of government in the economy continues to grow while the size of the private sector diminishes and it weakens further. I think it's also very important to understand that those stimulus plans that continue to be implemented by governments, both in the euro area or in the United States, those stimulus plans are going to mean more inflation or more taxes or less growth in the future. It makes no sense whatsoever to see that the administration in the United States expects their own figures a 14 trillion accumulated deficit between 2023 and 2030. That is insane, insane. And that, if monetized, means more inflation, with an inflation that has not been curbed yet. And we have seen how the media narrative is that the fight against inflation is over, when it is not. When it is not, because to combat inflation, you need three things, and the three things at the same time. One, obviously, is to hike rates to a normal level with inflation expectations, at least. And obviously, it would be preferable to let rates float freely. Second is to reduce the quantity of money in the system, which will come not just from lower credit, but also from lower financing of deficits. And third is a prudent fiscal policy. Ultimately, and just to finalize, when we talk about sound and unsound money, it's one side of the coin that has on the other side sound and unsound fiscal policy. Fiscal policy is what dictates unsound monetary policy. And if governments continue to increase massively their deficits, they are going to continue to make people poorer. And citizens are starting to understand that equation. Thank you very much for your interest. I believe that you are muted.
Can you hear me?
I can hear you now.
There we go. An exceptionally broad and insightful presentation, Daniel. Thank you very much. A lot of people have been on the chat here telling me how interesting and informative they found that. By the way, a number of people liked your comment on the lender of first resort in reference to QE and various central banks. And I think therein lies the problem. What was once an unconventional monetary policy tool has now become very normalized and kind of the go-to policy response of central banks, which then creates lots of other issues. And if you follow the institute, we blame it a lot for the current inflation that we have, especially when you enact it into a supply constraint. We do have a lot of questions. We're not going to get through all of them, I can tell you that. I'm going to start with Juan Castaneda of the Vinson Center, who you are aware of. He asks a couple of questions. The first one, can you give an estimate on the size of the malinvestment because of the too low interest rates in recent years? This will give people a good insight into the expected effects of the current normalization that's taken place in central bank policy rates.
There are a number of analysis of malinvestment that credit agencies publish. Obviously, they don't talk about malinvestment. Huh?
No.
But I think it's very evident, for example, in the abnormal amount of default rates in an environment of hiking rates. No, so what that shows you is we are seeing, for example, that those default rates reach levels that we have not seen in periods similar to these ones. But the best analysis I have seen is one that looked at the capital expenditure of the largest companies in the Stocks 600 and checked what was the economic value added of that capital expenditure through the period 2011 to 2018. And it showed that the level of value destruction in that economic value added was phenomenal. No, so the size is the thing is that the size is so enormous, no? That it's usually disguised with well, it was because of the Eurozone crisis, it was because of the Ukraine crisis. There's always an excuse, no? There's always an excuse, but ultimately what it shows is that if companies are generating, if the zombification of companies has multiplied, and at the same time the economic value added of a capital expenditure has reduced, is that the size is enormous. Yeah.
Okay, and I'm going to squeeze a second one in from Juan because it's something I'd like to know as well. I mean, where do you envisage the new normal for central bank policy rates? I mean, are we looking 3-4%? Does that sound about right to you? Or, I mean, even with the leverage in the system, currently that's going to be quite repressive at those levels. But do you think that's about the right level we'll settle at?
I think that 3.5-4% is consistent with the estimates of long-term inflation. So unless we have an abrupt reduction in inflation or even deflation, it would be very difficult to see it below that level. Because let's remember one thing that I forgot to mention in my presentation, is that central banks are loss-making. No? It's a huge difference that people tend to overlook. The fact that they're making losses in their bond portfolio, the losses that obviously for everyone that's listening are going to be paid by us, are going to make it very difficult for them to undertake loose monetary policy in an environment of persistent core CPI.
Okay. A question come in. Do you think we could see a return to further bouts of QE and central bank balance sheet expansion if we experience another downturn?
Absolutely. Don't even doubt it. Don't even doubt it. You know, this is like the Pringles advert. Once you pop, you cannot stop. The
Well,
size.
I mean, that's going to follow on to my next question. Then I guess Tim Congdon, our founder and chair, put out a special note last week highlighting that if when policymakers don't pay attention to the monetary aggregates, they make errors in their ability to correctly forecast inflation. Given that QE is very much part of the policy toolkit now, do you think we'll ever see central banks incorporate the monetary aggregates into their models?
I hope so. I don't think so. We have seen in the past decade or so a very concerning trend, which is that the vast number of economists and experts that central banks have in their payroll have gone from paying a lot of attention to monetary aggregates to paying no attention to monetary aggregates and generating this self-created fallacy that monetary aggregates don't matter for a monetary entity. Think about this. Imagine, I don't know, a supermarket saying that food is not something that they care about, that they look at. No, so I'm afraid that we will see the following in the next few months. The people that have been quiet because inflation has risen and that say, well, now they're starting to be vocal. The people that were quiet saying that increasing money supply and lowering rates would not create inflation, that it was a myth, etc., they were quiet for a very brief period of time because they found that they were wrong. But they've changed the narrative. And what they've changed is the narrative. And Stiglitz is saying now, for example, that the Fed has done everything wrong because they haven't looked at the problem, which is a supply problem and not a demand problem. No? So what they're going to do now is that monetary aggregates are declining, but as I was mentioning before, deficit spending is not reducing. So if inflation remains persistent, they will, and mark my words, say, all of you stupid monetarists were wrong because monetary aggregates are declining, but inflation is persistent, so it's a supply side problem. It's a cost push inflation problem, as we have always said. So print more. That's what they're going to say. Mark my words. However, what we need to say is this aspect that I mentioned before all the time, is that this is the first time ever in which, in a period of high inflation, governments are spending more, not less. Huge difference.
Well, given the unsustainable US budget deficit, and importantly, obviously, a contraction in the money supply, which is, as you pointed out, ongoing, do you think the Fed will be able to achieve a soft landing?
Well, the Fed is able to achieve a soft landing in aggregate terms for very simple reasons. GDP is very easy to maintain relatively stable. You increase government spending, you reduce imports, boom, and the GDP is up. What we are seeing right now, and I think it's very evident in the PMIs, in the Eurozone, for example, you see an 0.6% growth in GDP, yet PMIs in contraction in services and in manufacturing. So there's a discrepancy in the data between the official GDP and what we live every day. No? And that obviously adds to the fact that the PCE deflator can be more than debated, to be fairly honest. That's the other one. No, that's in GDP. So in official terms, the Fed is achieving a soft landing. In the private sector terms, the Fed is achieving a private sector recession and a public sector bloat, and that is extremely dangerous for the future.
I would agree with that as well. Changing the topic slightly, your views on the expanding mandates of central banks into other areas away from price and financial stability, namely green policies, and the forcing of these policies onto the commercial banking sector. Obviously, these green policies tend to be quite inflationary. Do you have a view on that and the compatibility with free market economy, and or maybe the effect on inflation generally?
Well, it's extremely concerning, to be fairly honest. It is extremely concerning that a monetary institution that has stopped paying attention to monetary aggregates is including in its mandate something as loose as climate change. Because what does that mean? To be fairly, from a monetary perspective, no? What does that mean? That banks are going to lend more to green economy and less to fossil fuel economy? Does that mean that we're going to mine less copper and less cobalt, which are essential to renewables? Yeah. All of these things that we have mentioned in the presentation, how dangerous it is to implement central planning from a monetary and from a fiscal perspective, add even more in something as loose as climate change. Because I think that the central bank is going to generate, probably like it did, by the way, with quantitative easing, is going to generate the opposite effect of what it looks to generate. Quantitative easing was supposed to be an extraordinary tool to give time to governments to implement structural reforms and to reduce risk in the market. It increased risk in the market, and governments stopped paying attention to their structural imbalances. And the same thing is going to happen if they put climate change in their policy, because climate change cannot be implemented from a monetary climate change battle, or how you want to call it, cannot be implemented on a monetary aspect. What you need to do is to ensure that capital is efficiently sent to those that are going to do things more rapidly, cheaply, more innovatively, with more technology, and that is not going. That doesn't work that way.
Sure. No, I agree. Something that's been overlooked really recently is the possible impending challenge for Europe, or energy challenge for Europe, as we approach another winter. Specifically higher prices and the impact on inflation. Do you have any comments on that? I mean, I haven't really heard much about it in policy talk or even the commentators in the market, to be honest.
And I find it very surprising, because the energy crisis in Europe was called as and abandoned with a view that everything was sorted out simply because there was a mild winter and there was the tailwind of declining commodity prices. The Eurozone's entire improvement between March to December came from lower imports, that is, lower cost of prices of gas, price of oil, etc., etc. Now, as I said, since the central banks have started to talk about the end of rate hikes, commodities have started to creep up, all of them. Oil is now up 6% on the year. That is obviously going to come back to bite the Eurozone, because it has not solved its structural imbalance. In fact, it has worsened it, because since the energy crisis, Germany has shut down more nuclear terminals, in Spain as well. So it's more dependent on natural gas now than it was before. It's more dependent on coal. Germany also on lignite, which is the same. And it's certainly not going to help into a winter that doesn't start well with the latest PMI figures.
Okay. We're having lots of questions still come in. I mean, I'm very conscious of the time, so I'm just having a quick look if we can get through a couple more. What is your opinion? What is your opinion on the spillover effect of excessive monetary expansion to developing and emerging economies? Do you think the risk is still elevated?
Yeah, that is another important factor. And I think that it's another important factor because it's extremely egotistical from developed economies to say that the monetary expansion of the 2009 to 2018 period caused no inflation, when in emerging economies you had massive food price inflation, etc., etc. No? So the fact having the world reserve currencies, the dollar and the euro, the dollar obviously the world reserve currency, and the euro allows you to transfer some of the monetary imbalances to developed economies. And I completely agree with whoever made the question, if that was the line that he was implying, that we have certainly made emerging economies poorer by massively increasing our monetary imbalances in developed economies.
Thank you, Daniel. There are a lot of questions. As I say, people will unfortunately have to email into us, and we can pass your questions on to Daniel. I will end, bearing in mind we're in the UK, I will end with, if you don't mind, one question on the UK. Do you think the UK has to experience a recession, even if it's a mild one, to bring inflation back to the 2% target?
Well, a recession would be inevitable, wouldn't it? No. The question is a recession is not negative. A recession, if it comes from bringing back the budget to sanity and the public sector reduces its imbalances and the deficit spending is controlled, is a positive thing, because at the same time, the UK has extremely low unemployment, which is great, and it has a thriving private sector, and it's an open economy. So it's got very positive things. So I would say it would be very, very positive if there was a mild recession coming simply from the fact that the part of GDP that government implies is relatively reduced to be more fiscally prudent.
Yeah, I agree with you, and the Institute agrees as well. It's inevitable that the UK will enter into a recession either the end of this year or the start of next year. So, Daniel, I know it's late there for you in Spain, and I really do appreciate all the time that you've given us today. I know you're a very busy person and in high demand. So, Daniel, thank you very much for being so generous with us. And with that, I will wish everybody a good evening. Thank you.
Thank you very much. Thank you.
Thank you,
It's been an
Daniel.
absolute pleasure.
Cheers. Thank you.